Welcome to another one of our videos, and in today's topic we're discussing how to bulletproof your investment portfolio, especially as a beginner investor. Now, before we continue, if we hit 1,500 subscribers, I'm giving this book away to one lucky winner. So make sure to like, subscribe, and share this video with somebody who can find value in it. Now, a solid investment portfolio should tick a few boxes. You should have stability, number one. You should have good growth over the long term, and you should avoid unnecessary risks. So as we go through this, we're going to tick all of these boxes and give you a framework that you can consider on how to build a bulletproof investment as a beginner. The first thing you need to consider is an emergency fund. This is your safety net, and I like to refer to it as your springboard to wealth creation. Now, you need to focus on getting an emergency fund of ideally between 3 to 6 months of your monthly expenses. The reason for that is that when market volatility picks up, let's say maybe in your retirement funding, your unit trusts, or your endowments, your ETFs, whatever it may be, you're not forced to sell, or you're not forced to sell when emergencies arise, like you need new tires on the car, which is wear and tear. Now, some of the ideas where you can keep these funds: 3 places. Consider the bank, where you're getting a return of at least inflation plus some extra. You don't want your money in the long term to be eroded by inflation. Number 2 is you can consider a conservatively structured unit trust, maybe a money market or an income fund, to make sure that you're staying up to date with inflation, which also gives you that flexibility that when need be, you can make a withdrawal against those funds. And thirdly, if you have an access bond, you can keep the funds within your access bond as well. One of the other most important things to consider regarding an emergency fund is it's going to really help you not dip back into debt. So once you've got your debt under control or even settled, if you have an emergency fund, you're most likely going to say goodbye to those high interest rates on your credit cards and your loans. Number 2, you have to look at retirement funding after you've had your emergency fund in place. You have to make provision for when you're not able to work anymore. Now, considering the options that we're looking at, there's 3 options that you can look into. If you work for a company that offers a benefit, you've probably got a pension fund or a provident fund with work. If not, you can consider a retirement annuity. Now, the stats are absolutely shocking. Only 5% of people in South Africa are able to retire successfully. And a couple of years ago, one of the big investment platforms in South Africa done a study. And of that 5% that's able to retire, 80% of them had to join the workforce again within 5 years of retirement because they haven't saved enough money. So it's absolutely crucially important to consider this in your portfolio. Again, why is retirement funding so important? All your money grows tax-free. No interest tax, no CGT, no dividends. So we're deferring the tax up until the day you retire, which really helps you maximize your growth from a compounding interest effect. It also helps you with disciplined savings, so you can't unnecessarily draw the money if you run into trouble. And that's what point number 1 takes care of, is that if you run into trouble, we've got an emergency fund. The third thing we need to look into is maximizing tax on a secondary basis, and that we do through a tax-free savings investment. Now, how that works again is you're allowed to save 36,000 Rand per annum in 1 tax year, or a maximum of 3,000 Rand per month, with a lifetime limit of contributions of 500,000 Rand. Now, unlike a retirement annuity, there's not legislation governing where you're allowed to invest this money. So you can invest this money as aggressively as you want to try and maximize the returns you can over those limits that I've already mentioned. And all the growth on this becomes tax-free. What a tax-free investment can also help you with is the day you retire and you have a tax-free as well as a retirement or a pension fund, you don't need to make the withdrawal on your retirement funding because you have the tax-free investments available. Then lastly, after we've hit those 3 check boxes, let's look at some longer-term wealth creation options. And there we can look at managed unit trusts, or we can invest in the stock market, considering ETFs, going into property, business, or whatever the likes. But what that then creates for you is the opportunity to say you're allowed to take on more risk because you've safeguarded yourself in these steps to make sure that if something doesn't work out, you're not financially ruined. Some other considerations of long-term wealth investments that you can use is global investments, so you can invest offshore and benefiting from the depreciating rand against the dollar. You can use rental property, you can buy long-term government bonds, crypto, whatever it is that you're looking at. Just make sure that you set up your portfolio to weather any storm. An interesting fact, when COVID-19 hit, the balanced to aggressive portfolios fell between 20 to 40% within 1 week. If that was your only investment at that point in time, you wouldn't have been sleeping really well. So make sure you set up your portfolio appropriately so that you can go out and take the necessary risks. Right, that's it. That's how you bulletproof your investment as a beginner when it comes to investing. And a few things to consider. Focus more on consistency than chasing the best returns, because your behavior around how you save and invest will yield a lot more return for you than chasing the biggest returns in the market. Also, automate your investments. Don't wait every month until you get paid and make the ETF. Rather, set up frequent debit orders to the specific vehicles so that you know that you're saving in the right places. Another one is stay diversified. Have a nice blend between conservative, moderate, and aggressive investments to cater for all these different investment plans and horizons that you're looking at. And lastly, don't withdraw your dividends. Reinvest your dividends so that you can make the best out of the compounding interest. So that's that. Thanks for watching another one of our videos. And if you've ever wondered specifically how a retirement annuity works, make sure to watch this next video in the link below. Cheers.